Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is November 4th, 2024, and we're diving into Knife River's third quarter earnings report. Knife River, a leader in construction materials and contracting services, has just released its financial results for the quarter ending September 30th, 2024. Joining us today is John, Senior Analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. It's a pleasure to discuss Knife River's performance, especially given their record-breaking results this quarter.
Revenue and profitability overview. Let's start with the top line. Knife River reported a net revenue of $1.1 billion for the third quarter, marking a 1% increase from last year. John, what are the key drivers behind this revenue growth?
Despite a slight decline in volumes, Knife River achieved record revenue primarily due to price increases in their aggregates and ready-mix product lines, as well as increased contracting services revenues. This strategic pricing adjustment has helped them maintain growth, even with reduced volumes.
And how about profitability? The company reported a net income of $148.1 million with earnings per share at $2.60. How does this compare to their previous performance?
Net income saw a modest increase of 1% from the previous year, reflecting the company's ability to manage costs effectively and optimize pricing. Their gross profit also rose to $273 million, indicating strong operational efficiency and margin management.
Operational efficiencies and future outlook. Knife River's adjusted EBITDA came in at $245.2 million, slightly down from last year. What factors contributed to this performance, John?
The slight dip in adjusted EBITDA is primarily due to anticipated reductions in their energy services segment, where liquid asphalt pricing decreased. However, their geographic segments showed a combined 6% increase in EBITDA, which helped offset this decline.
Looking ahead, Knife River has narrowed its revenue and adjusted EBITDA guidance for the full year. What does this tell us about their future outlook?
The narrowed guidance reflects Knife River's confidence in their pricing strategies and acquisition plans. They expect revenue between $2.85 billion and $2.95 billion, with adjusted EBITDA ranging from $445 million to $465 million. This suggests a strong finish to the year and a focus on long-term growth.
Strategic acquisitions and segment performance. Knife River has been active on the acquisition front, spending $129.3 million on 6 acquisitions. How are these expected to impact their business?
These acquisitions, focused on aggregate reserves and construction materials, are expected to generate attractive financial returns. Notably, the purchase of Albina Asphalt will expand their high-margin liquid asphalt product line, enhancing profitability in key markets.
Can you give us a brief overview of how their different segments performed this quarter?
Sure. The Pacific segment saw a 5% revenue increase to $165 million, driven by construction activity and price hikes. The Northwest segment achieved a record EBITDA of $55.9 million, thanks to public agency construction work. However, the Energy Services segment faced a 10% revenue decline due to lower liquid asphalt prices.
Capital allocation and financial health. Let's talk about Knife River's capital allocation strategy. They've spent $127.2 million on capital expenditures so far. How does this align with their strategic goals?
Knife River is committed to disciplined capital use, focusing on maintaining and improving operations while also pursuing growth through acquisitions. Their capital expenditures are aligned with their competitive edge strategy, emphasizing quality and efficiency improvements.
And how is their financial health looking?
Knife River is in a strong financial position, with $220.4 million in cash and equivalents and a net leverage ratio of 1.x. They also have $329.4 million available under their revolving credit facility, providing ample liquidity to support future growth initiatives.